Chapter 1. Investing Basics. Section 1. What is investing versus trading? Investing and trading both involve putting your money into the market, but they serve very different purposes. Think of the mindset difference. An investor buys quality assets and holds them for years or decades, focused on long-term growth. A trader, by contrast, watches price movements and momentum, buying and selling in seconds or months, aiming for short-term profits from market swings. Time horizon is the clearest dividing line between investing and trading, and it shapes every decision that follows. Investors hold positions for years, allowing compounding and market recoveries to work in their favor, even during downturns. Traders, on the other hand, hold for minutes to months, where small price swings become critically important and require precise timing. The longer your time horizon, the more the market's natural ups and downs fade into background noise, while shorter horizons make every tick matter. Because investors and traders work on different time horizons, they use completely different tools to evaluate opportunities. Fundamental analysis looks at a company's revenue, earnings, and competitive advantages to determine if it will grow in value over the long run. Technical analysis, on the other hand, focuses on chart patterns, support levels, and momentum to predict whether a price will move favorably in the near term. Neither approach is superior. They are simply the right tools for different jobs. A single trade might cost you just $5 in commissions and spreads. But make 200 trades in a year, and all those small fees add up to $1,000. That's 10% of a $10,000 account gone before you've earned a penny. So, trading more frequently creates a bigger hurdle of commissions, spread costs, and short-term taxes that your returns must clear just to break even. The first practical step is to define your time horizon, as this choice comes before selecting any asset. If you plan on holding for many years, think of a steady upward line that's an investing approach where you're focused on long-term growth. But if you're exiting in days, hours, or even minutes, you have a trading approach with a focus on short-term price moves. Your time horizon determines which assets to choose, what to study, and even how you measure your success. Once you know your strategy, the next step is choosing assets that match it. Investors typically build a foundation with diversified ETFs, index funds, and shares of established companies, focusing on quality and steady growth. Traders, on the other hand, look for heavily traded stocks or major currency pairs where liquidity allows them to jump in and out quickly. For a trader, a stock that barely moves is useless. Volatility is essential for finding opportunity. Before you act, you need a clear plan. Investors analyze financial statements to find a reasonable buy range, while traders study charts to set exact entry, stop loss, and take profit levels. The key discipline for both is that the exit plan must be in place before you enter, because a solid plan protects you from emotional decisions in the heat of the moment. Finally, accounting for costs and taxes is where many plans fall apart. Every commission, spread, and tax on a realized gain eats into your returns. While long-term investors face minimal drag from infrequent trades, active traders can see their costs compound dramatically, sometimes turning a winning strategy into a net loss. Always evaluate any investment strategy after costs, not before, because that's the only number that actually counts. Meet Alex and Jordan. Both start with $10,000, but take very different paths. Alex invests that money in an index fund and simply holds it for 5 years, letting an average 8% return grow it to nearly $14,700 through the power of compounding. Jordan takes a much more active route. They use the same $10,000 to make 200 day trades, aiming for a 1% net profit on each one. Alex's outcome relies primarily on the long-term growth of the market, a factor that is more predictable over time. Jordan's success, on the other hand, depends entirely on their skill, discipline, and a significant amount of luck in making consistently correct short-term decisions. Both investors and traders tend to fall into the same predictable traps. Common mistakes include confusing temporary market swings with a permanent loss, ignoring how fees quietly eat away at your returns, and overestimating your ability to predict short-term price movements. Another major mistake is using borrowed money or leverage, Without realizing, it magnifies your losses just as much as your gains. Most importantly, never choose an investing approach just because you see others making fast money. That kind of FOMO often leads to decisions that don't fit your own goals. Neither investing nor trading is better overall. They serve different financial goals. Think of investing like planting a tree that grows slowly over years, while trading is more like catching lightning in a bottle. For most people starting out, the patient, lower maintenance path of investing is usually the most practical first step. The best choice is simply the one that matches your personal goals, how much time you can commit, and how much risk you're comfortable with. Not everyone needs to trade, and that's perfectly okay.